In September of last year, ASIC released a new regulatory guideline that defined a hedge fund according to 5 characteristics. Firstly, an investment manager who adopts a more complex investment process, such as looking to generate positive returns irrespective of the direction of the underlying market. Second of all, has the ability to short sell equities and other financial instruments. Thirdly, can use leverage. Fourthly, has the ability to charge performance fees. And finally, has the ability to use derivatives such as options, futures and other financial instruments. Now, according to ASIC, if a minimum of 2 of those 5 criteria are met, the investment manager is defined as a hedge fund. Now, there are many different types of strategies adopted by hedge funds. However, the one consistent theme amongst most hedge funds is the objective to generate positive returns, irrespective of whether the market is rising or falling. Firstly, let me say that absolute return managers often invest in assets other than listed shares. Some absolute return managers specialise in currencies, others specialise in commodities, some even specialise in fixed interests such as bonds. However, for the purpose of this discussion, I'll be referring to the most common absolute return fund strategy in the Australian context, which is the Australian Equity Long-Short Absolute Return Funds, of which there are 3 types: market neutral, variable beta and active extension. Now, in terms of market neutral, the investment managers are attempting to maintain a net exposure of 0 or close to 0 at all times. They do this by matching a long position with a short position in 2 different stocks, usually in the same sector. By dollar value matching both a long position with the short position, the absolute return manager is effectively maintaining a net exposure of 0 and are looking to profit from the differential in performance from both legs of that trade. Now, leverage will be applied on top to magnify the returns of that pair. In relation to active extension strategies, typically a 130-30 fund, the investment manager is looking to maintain a net exposure at 100% or close to 100% at all times. Now, they do this by shorting 30% of the fund and using the short sale proceeds to reinvest into the long positions. By pushing the long positions from 100% to 130%, they effectively move the longs to 130% and the shorts to 30%, hence the name 130-30. Now, variable beta is different again, and here you have an investment management team that have a large amount of flexibility to vary the net exposure of the fund depending on how bullish or bearish they are. Bennelong Kardinia Absolute Return Fund is a good example of a variable beta fund, where the investment managers have the flexibility to push the net exposure to a maximum of 75% net long if they are particularly bullish. If they are bearish or uncertain on the outlook on the equity markets, they have the ability to liquidate the portfolio to 100% cash or move the net exposure to 0%. And if they're outright bearish the markets, they have the flexibility to take the net exposure to a net short position of 25% net short. So as you can see, there's a lot of flexibility for the investment managers to express their view of the outlook of the equity markets through the portfolio.